Imagine trying to diagnose the overall health of, 1.4 billion people.
Right. You can't exactly ask them all to line up and just step on a scale.
Exactly. You have to look for vital signs in the data. And sometimes, well, sometimes that data gives you a complete heart attack.
Oh, definitely. Like, for example, last year.
Yeah. Last year, the Reserve Bank of India published data showing that while billions of rupees were supposedly, flowing into the agricultural sector, over 3.4 crore operative farmer credit accounts just seemingly vanished overnight. Poof, gone.
Which, I mean, it looks like a catastrophic crisis on paper. If you don't know how to read the diagnostic charts of the macroeconomy, you might assume the entire rural credit system just collapsed.
Right. And today we're going to uncover exactly where those 3.4 crore accounts went and, more importantly, why the RBI's entire playbook is fundamentally shifting away from simply handing people bank accounts to focusing on whether they can actually, survive while using them.
Yeah, it's a huge shift. And if you are joining us today, you are likely gearing up for a high-stakes professional examination in finance or banking. You're looking for an edge.
You don't just want to memorize a textbook, right? You want to actually understand the mechanics of the machine.
Exactly. So our mission for this deep dive is to completely unpack Chapter 4 of the Reserve Bank of India's annual report for the year 2025-26.
Which is titled Credit Delivery and Financial Inclusion.
Right. We're going to analyze the underlying logic, the raw data, and all the regulatory frameworks so thoroughly that you can walk into that exam room and basically deconstruct any question they throw at you.
We are your study partners today. Two senior analysts here to brief you and translate this incredibly dense regulatory jargon into the actual ground-level reality of how money moves in this country.
Because before we dive into the percentages and the endless acronyms, we have to establish why Chapter 4 is essentially the most important document for India's macroeconomic stability. I mean, why should a finance student care so deeply about financial inclusion?
Well, because financial inclusion is basically the circulatory system of the economy.
Right.
Like if you restrict blood flow to the extremities.
The rural farmers, the micro enterprises, the daily wage earners.
Exactly. If you restrict that flow, the body goes into shock. We are not talking about the mechanics of, corporate investment banking here. We are analyzing the transition of hundreds of millions of underbanked citizens into the formal, visible economy.
Yeah. If credit doesn't reach the bottom of the pyramid, the broader economic engine simply stalls out.
It just stops. This chapter is the literal blueprint for how the RBI is engineering the pipes to ensure that credit flows where it is needed most. Okay, let's unpack this. Let's start by looking at the 2025-26 scorecard.
Good place to start. Because in any regulatory analysis, before you look at the raw outcome data, you must evaluate what the regulator explicitly set out to do at the beginning of the year.
Right. Examiners absolutely love testing the delta between intent and outcome. So what were the stated goals the RBI drew up for themselves?
Well, the RBI laid out three massive primary objectives for 2025-26. First, they mandated a comprehensive review of the Financial Inclusion Index, or the FI Index.
Mostly because it had completed a full 5-year cycle since its inception, right?
Exactly. Second, they aimed to drastically strengthen the outreach and credit access for micro, small, and medium enterprises, the MSME sector.
Okay, and the third?
And third, they set a highly ambitious target for something called the EDDPE program. They wanted to achieve 100% coverage in 80% of the districts across the country by March 2026.
Okay, let's freeze right there on that acronym, because if there's one term you need to be deeply familiar with for the exam, it's EDDPE. It stands for Expanding and Deepening of Digital Payments Ecosystem.
Definitely a key exam takeaway.
But wait a minute, we need to clarify what 100% coverage actually means in this context. It doesn't mean every single citizen suddenly owns, like, a top-tier smartphone with a 5G connection, right?
No, not at all. I mean, that would be an impossible metric. The RBI's definition of coverage under the EDDPE is highly specific, and examiners will test you on this exact nuance.
So what is the definition?
Coverage means providing every eligible individual in the identified districts with at least one functional mode of digital payment. It is about establishing a single digital node for that citizen.
Ah, okay. So it's a menu of options. It could be issuing a basic RuPay debit card, or, it could be internet banking or mobile banking for those who do have smartphones.
Right. But it also includes the Unified Payments Interface, or UPI, an unstructured supplementary service data USSD for basic feature phones.
Or even the Aadhaar-enabled payment system, APS, which uses biometric authentication. The mandate isn't about the hardware then. It's about getting them onto the digital grid in at least one format that works for their specific socioeconomic reality.
Precisely. The APS is a perfect example of this. A daily wage laborer might not have a phone at all. But through Aadhaar biometrics, their thumbprint basically becomes their debit card at a local micro ATM. That counts as coverage.
That's fascinating. So the obvious question is, did the RBI actually hit this target? And the answer is yes. By March 31st, 2026, 100% EDTP coverage was achieved in over 80% of the districts.
And if you are taking notes, here is a number you absolutely must memorize for the multiple choice section.
Which is?
710. The exact number of districts that achieve this 100% digital payment coverage is 710 districts.
710 districts. Got it.
Yep.
It is a staggering logistical achievement when you consider the geographic and, linguistic diversity across all those districts.
It really is. But moving to their second goal, strengthening MSME outreach, they executed a very specific structural policy change that we really need to unpack. They raised the limit for collateral-free loans, specifically for micro and small enterprises, or MSEs.
Right. Here's another key exam takeaway. The collateral-free loan limit was enhanced from 10 lakh to 20 lakh, effective April 1st, 2026. Now, it's easy to just memorize those two numbers, but let's look at the actual mechanism of why this matters. I mean, why did they double it?
Let's use a real-world scenario to anchor this. Imagine a local, family-run commercial bakery operating in a Tier 3 city. They have been baking bread for 30 years, operating almost entirely on cash. They pay their suppliers in cash, take revenue in cash.
Right. They are successful, but they are completely informal.
Exactly. Now suddenly, they get an opportunity to secure a massive supply contract with a regional supermarket chain. But to fulfill that contract, they need a high-capacity industrial oven.
And let's say that industrial oven costs 18 lakh, so they walk into a traditional commercial bank to ask for a loan. But here's the structural friction. They don't own the building they bake in, they rent it.
Yep. They don't have large tracts of land or heavy fixed assets to pledge as collateral. Historically, a bank would look at them, see no hard collateral, and basically just reject the application because the risk weight is too high.
Right. Under the old regulatory framework, the bank could only offer them 10 lakh without requiring that hard collateral. That leaves the bakery a lakh short, the oven doesn't get bought, the contract is lost.
The business remains a micro-enterprise forever.
Exactly. But this new EUR collateral free limit is the regulatory bridge. By absorbing the risk at a systemic level, the RBI allows the bank to give the bakery the full euro lakh based on their cash flow history, not their real estate holdings.
That policy change is the exact mechanism that allows a micro business to scale into a small or medium enterprise.
It's huge. But this brings up a massive operational friction point. It's wonderful for the regulator to sit in a boardroom in Mumbai and draft circulars raising loan limits. But how does the RBI actually ensure that the owner of that bakery in a Tier 3 city even knows this 20 lakh facility exists?
That is a great point. Historically, there has been a massive information asymmetry between regulatory policy and ground-level awareness. There's a massive communication gap.
I was hoping you'd point that out because the RBI realized that drafting policy just isn't enough. You actually have to market it. So to bridge this communication gap, the RBI regional offices conduct ongoing MSME town hall meetings.
Right. But the major evolution for the 2025-26 cycle is a revised framework called MSME Samvad.
MSME Samvad. Samvad translates to dialogue or conversation, right?
Exactly. It's a decentralized, highly granular outreach mechanism designed specifically to operate at the district and regional level. The RBI realized that you cannot just, put an ad in a national newspaper and expect micro-entrepreneurs to fully understand banking policy.
No, they're busy running their businesses.
Right. You have to deploy officers down to the district level to have direct, face-to-face dialogues with the local industry associations and the business owners themselves. It's an aggressive push to close the information gap.
Okay, so we've established the intent and the outreach mechanisms, but talk is cheap, right? Let's look at the actual credit delivery statistics, because if we are talking about MSMEs and farmers getting loans, we need to follow the actual money. Where did the money flow this year?
This requires us to decode the mechanics of priority sector lending, or PSL.
Yes, PSL.
Priority sector lending is basically the cornerstone of India's credit delivery system. Because left entirely to free market forces, commercial banks would naturally gravitate toward lending only to massive corporations with pristine credit ratings and vast amounts of collateral.
Of course. It's safer and the margins are much easier to manage.
Exactly. So to counter this, The regulator mandates that a specific percentage of a bank's lending simply must go to sectors that are vital for the inclusive macroeconomic growth of the country. This includes agriculture, MSMEs, export credit, education, housing, and social infrastructure.
Now, if you are looking for a highly testable metric for the exam, this is it. The overall PSL target for scheduled commercial banks or SCBs is 40%. But a percentage is meaningless unless you know the denominator. It is 40% of what?
This is where the jargon gets a little heavy, but we have to master it. It is 40% of ANBC, which stands for Adjusted Net Bank Credit, or CEOBS, which is the credit equivalent of off-balance sheet exposure, whichever of those two figures is higher.
Okay, hold on. Let's stop right there. Adjusted net bank credit. Explain A and BC to me like I'm 5 years old. What is the bank actually adjusting in this equation? What real-world money does that represent?
It's a great question. In very simple terms, a bank's net bank credit is the total amount of outstanding loans they have actually giving out. But the RBI allows them to adjust this number.
How so?
For example, if the bank has invested in certain non-SLR bonds, like bonds issued by the National Bank for Agriculture and Rural Development, NABARD, they get to add that to their credit figure. They also subtract certain bills they've rediscounted.
Oh, I see.
So A&BC is essentially the truest reflection of a bank's total deployed capital that is relevant for these systemic lending targets.
Okay, that makes sense. But what about the second one, CEOBSE? Credit equivalent of off-balance sheet exposure. What kind of lending happens off the balance sheet?
Think of things like letters of credit or bank guarantees. If a bank guarantees a payment for a client, they haven't actually handed over any cash yet, so it doesn't sit on the balance sheet as traditional loan. But they have still taken on financial risk.
Right, they're on the hook if things go bad.
Exactly. So CEOBSE is a formula that converts those guarantees and off-balance sheet risks into a standard credit equivalent number. So the RBI says take your ANBC and your CEOBC, whichever number is bigger, 40% of that must go to the priority sector.
Got it. The denominator is basically the maximum expression of the bank's total risk exposure. So the mandate is 40%. What is truly fascinating here is the performance data for 2025-26. The scheduled commercial banks didn't just scrape by to meet the 40% target.
Not at all.
They achieved 45.0% as of March 31st, 2026.
And it wasn't just the large public sector banks carrying the weight, which, has historically been the case. Every single bank group, public sector banks, private sector banks, foreign banks, and small finance banks, they all met the mandate.
Wow. To visualize why this 45% figure is so important, think of priority sector lending like a strict nutritional mandate for a massive school cafeteria.
I love this analogy.
Yeah. The RBI is the nutritionist, right? And they dictate that 40% of the calories the credit served to the economy must come from healthy foundational food groups like agriculture and micro enterprises.
Right.
In the past, banks treated this like eating their vegetables. They did it because they were forced to by the regulator. But the data showing a 45% achievement proves something fundamental has shifted. They aren't just serving 40% out of reluctant regulatory compliance.
No, they are actively choosing to lend more to these sectors. Lending to the bottom of the pyramid is no longer viewed as a regulatory chore or a guaranteed loss. It has evolved into a profitable core business strategy. And that strategic shift is glaringly obvious when you look at the specific MSME credit growth data. The outstanding credit to MSMEs by scheduled commercial banks grew by an astonishing 23.5% year-on-year, comparing the end of December 2024 to December 2025.
A 23.5% growth rate in a single year is massive for a sector that size. The sheer volume is staggering. Total outstanding credit to MSMEs reached 36.8 lakh crore.
That's a huge number.
And that capital is distributed across 234.7 lakh accounts. We are talking about nearly 2.35 crore individual micro and small businesses receiving formal credit.
It's incredible. But this brings us back to that massive anomaly in the data we mentioned at the start. And examiners will definitely use this anomaly as a trap to see who actually read the report and who just skimmed the headlines.
Yes, the vanishing accounts. Let's look at the data table for Kisan credit cards, the KCCs. These are the primary credit delivery vehicles for farmers.
Right.
If agricultural and priority sector credit is booming, if banks are hitting 45% PSL, why did the number of operative Kisan credit cards fall off a cliff?
It looks so bad on paper.
It does. According to the report, the number of operative KCCs dropped from 290.2 lakh in 2024-25 down to 256.2 lakh in 2025-26. That is a drop of 3.4 crore operative accounts. If I'm an analyst looking at this without context, my immediate assumption is that the agricultural sector just experienced a devastating credit contraction. Like, did 3.4 crore farmers just suddenly stop borrowing?
Well, if you write a drop in agricultural credit demand on your exam, you will absolutely fail that question.
Good to know.
It looks like a crisis, but it is actually just a data illusion. The decline in operative KCC accounts is primarily because select private sector banks undertook a massive internal data cleanup exercise. They began reclassifying or declassifying certain exposures that were not perfectly aligned with the extant highly strict KCC guidelines.
So it wasn't an evaporation of farmers, it was an evaporation of bad data categorization.
Exactly. For years, some private banks might have been, loosely categorizing various rural or semi-urban loans under the KCC umbrella just to easily hit their agricultural subtargets.
Oh, wow.
Yeah, so the regulator cracked down on the definitions. The banks audited their portfolios and shifted millions of accounts out of the KCC category and into other loan classifications.
And we know definitively that the actual capital didn't disappear because the report gives us the total outstanding amount under the KCC scheme, which still stands at a massive 5,071,444 crore. Right. The money is still actively working in the fields. It is just being categorized and monitored with far more precision now.
Exactly. But, this entire discussion about funneling 5.7 lakh crore to rural farmers and 36.8 lakh crore to MSMEs brings up a massive logistical hurdle.
Which is?
You simply cannot execute that kind of granular capillary-level lending from a corporate headquarters in a major metropolitan city like Mumbai or Delhi. You have to physically reach the village level.
Right. How did the RBI and the government actually build the physical and digital pipes for this money to flow? Like, what is the actual infrastructure of inclusion?
Well, to build that infrastructure, the Department of Financial Services, or the DFS, didn't just run some television ads. They initiated a massive campaign for the absolute saturation of financial inclusion schemes, and they targeted this campaign specifically at the Gram Panchayat level.
Which is the lowest, most foundational tier of local governance in India.
Exactly. And the RBI's involvement here was fascinating. They used this saturation campaign as a brilliant Trojan horse.
A Trojan horse? How so?
The mandate was to ensure the re-KYC, the renewal of Know Your Customer details, for all accounts where it had fallen due. Now, getting rural citizens to take time off and come in to update their paperwork is notoriously difficult.
Very true.
But while the banking system finally had the customer's attention for this mandatory re-KYC process, the RBI mandated that banks use that exact interaction to resolve pending customer grievances and actively promote awareness about returning unclaimed deposits.
Oh, that's smart. It's a masterclass in operational efficiency. If you finally get the customer in the room, don't just ask for their Aadhaar card. Ask them if they have a problem with their account, and check the database to see if their grandfather left an unclaimed deposit a decade ago.
Right. But coordinating thousands of banks to execute this simultaneously requires a very rigorous management structure.
Which brings us to another key exam takeaway: the lead bank scheme, or LBS. This is a brilliant structural solution to a massive geographical problem. If you memorize one concept about banking infrastructure today, make it the lead bank scheme.
Definitely.
Because you have dozens of banks operating in the country. If you just tell them all to go include people, they will naturally all flock to the most profitable, easily accessible, semi-urban centers, and the truly remote districts will be completely ignored.
Right. The lead bank scheme solves this tragedy of the commons. The RBI essentially appoints one specific bank to be the project manager for financial inclusion in a specific district.
Okay.
The lead bank isn't the only one lending there, obviously, but they are responsible for coordinating all the other banks, the local government, and the credit agencies to ensure the entire district is covered comprehensively.
And you need to know the current makeup of who is carrying this responsibility for the exam.
Cool.
Currently, 12 public sector banks and 2 private sector banks hold lead bank responsibility.
Yes, and examiners will absolutely ask you to identify the 2 private sector banks in this list.
Let me guess. Jammu and Kashmir Bank and ICICI Bank.
You got it. Jammu and Kashmir Bank and ICICI Bank. Altogether, these 14 banks manage this project manager responsibility across 764 districts.
That's a huge operational footprint. Now, with all these localized initiatives, how does the RBI essentially track the progress? Historically, banks submitted something called the FIP return, the Financial Inclusion Plan return.
Right.
But if we analyze the 2025-26 annual report, there has been a major data shift.
A huge one. The RBI officially retired the old FIP return in March 2025. The new standard by which all financial inclusion progress is measured is the MPFI return.
Key exam takeaway here.
Yes, MPFI stands for Monitoring Progress of Financial Inclusion. If an exam question asks what reporting structure is currently in use, cross out FIP immediately and select MPFI.
MPFI, got it. And when you look at the raw data coming through that new MPFI return, one particular piece of infrastructure stands out as the absolute backbone of the entire system.
Yeah.
The business correspondents, or BCs.
Let's spend some time on the BC model, because this is exactly how you bank the unbanked in areas where building a traditional brick-and-mortar bank branch with security guards, air conditioning, and a massive vault is completely economically unviable.
Right, it just wouldn't make sense.
Think of a BC as a highly trusted local figure. Very often, it is the village kirana store owner, the local grocer.
Oh, that makes perfect sense. So the bank basically equips this Kirana owner with a biometric micro ATM device.
Exactly. And suddenly that local grocer becomes the human ATM, the teller, and the local branch manager rolled into a single person.
Wow.
When a farmer gets a DBT, a direct benefit transfer from the government, they don't have to take a bus for 3 hours to a bank branch in the next town. They literally walk down the dirt road to the Kirana store, press their thumb on the scanner, and the grocer hands them the cash from their own till.
While the digital backend instantly settles the transaction between the grocer's account and the farmer's account, that is incredibly efficient.
It really is.
And the scale of this network is hard to comprehend. Like, physical brick-and-mortar bank branches in India stand at roughly 1,070,189. That took decades to build. But the BC network? There are now 11,075,250 fixed-point BC outlets.
Over 1 million. And pay attention to the term fixed point.
Why is that important?
Because the RBI doesn't just want roaming agents who might be in a village one day and gone the next. To be classified as a fixed-point BC outlet, they must maintain predictable availability, working a minimum of 4 hours per day, 5 days a week.
Consistency is key.
Exactly. Furthermore, 64% of these BC outlets are located in deep rural areas. They are the actual capillary network distributing that 5.7 lakh crore in agricultural credit we talked about earlier.
Okay, but this all paints a very rosy picture. I'm going to push back here a little bit.
Go for it.
We have 1.7 lakh branches, 11.7 lakh BCs, 710 districts with 100% digital coverage. You can build all the plumbing you want, but you cannot force the water to flow.
Right.
So how does the RBI actually know if true, meaningful inclusion is happening? How do they know they haven't just forced banks to open millions of dormant, zero-balance accounts that just gather dust so they can hit a quota?
That is the exact systemic vulnerability the RBI recognized. Raw infrastructure numbers simply don't equal financial health. To answer that question, the RBI created its own proprietary scorecard, a composite metric to measure the true depth of inclusion. It is called the Financial Inclusion Index, or the FI Index.
Okay, this is perhaps the most heavily tested section of the entire chapter. Students, listen up. The FI index score improved to 67.0 in March 2025. This is an increase from 64.2 in March 2024. Remember the number 67.0.
A very important number.
But the overall score is just the headline, really. You need to deeply understand the methodology of how it is actually calculated because it reflects the RBI's entire philosophy.
Right. The index is a composite of 3 sub-indices, each with a specific weight. The weighting is a guaranteed exam question. The weights are usage at 45%, access at 35%, and quality at 20%.
Let's use an analogy to make these abstract percentages tangible. Let's compare the national financial system to a gym membership.
Oh, I love this analogy. Let's map it out. So access, which makes up 35% of the FI index, is simply the act of building the gym in the neighborhood and handing a person their membership card.
Right.
In macroeconomic terms, access is opening the zero-balance bank account, establishing the fixed-point BC outlet in the village, and issuing the RuPay debit card. For the last decade, India's primary focus was almost entirely on access. Build the accounts.
Right. But just having a plastic gym card sitting in your wallet doesn't lower your cholesterol.
Unfortunately not.
Just having a bank account doesn't pull you out of poverty. Which brings us to the most heavily weighted metric. Usage at 45%. Usage measures how often you actually walk into the gym and whether you are utilizing the treadmill, the free weights, and the rowing machine, or just, sitting in the lobby checking your phone.
Exactly. Financially, usage measures the active engagement with the ecosystem. Are they maintaining a balance? Are they accessing MSME credit? Are they buying microinsurance policies? Are they actively sending and receiving digital remittances? It tracks the velocity and variety of financial behavior.
And finally, you have quality. which is weighted at 20%. Quality is having a certified personal trainer at the gym so you don't try to lift 300 pounds on your first day and tear a muscle. It is ensuring the equipment is well maintained and safe to use.
In the banking world, quality is the protective layer. It measures the spread of financial literacy. It measures the robustness of the grievance redressal mechanisms we talked about earlier. It measures the lack of mis-selling by bank agents.
Mis-selling is a huge issue.
Right. If a BC convinces a financially illiterate farmer to take on a high-interest loan they do not understand, and that farmer defaults, that is a catastrophic failure of quality.
And here's where it gets really interesting with the 2025-26 data, the underlying trend. The jump in the FI index from 64.2 to 67.0 was not driven by access. It was driven primarily by improvements in usage and quality.
That is the macro transition you need to understand for your essay questions. The needle is finally moving because the citizens are actively using the system and they are using it safely.
However, we have to look at this objectively. A score of 67.0 out of 100 means there is still 33% of the landscape left to conquer. If 67 is basically a D+ or a C grade, it begs the question, what is the regulator's grand strategic plan for closing that massive remaining gap over the next half-decade?
Which brings us to the transition from the current state of play to the future roadmap. We're talking about the National Strategy for Financial Inclusion, the NSFI, for the period 2025-30.
Right, and if you get a question on the origins of the NSFI 2025-30, you need to navigate a bit of an alphabet soup. It was formulated under the aegis of the TGFIFL.
TGFIFL. That stands for the Technical Group on Financial Inclusion and Financial Literacy.
But hold on, look at who actually sits on the TGFL. It isn't just the RBI sitting in a room alone talking about interest rates. The group incorporates SEBI, the securities regulator,
IRDAI, the insurance regulator,
CRDA, the pension regulator, NABARD, the agriculture bank, the National Skill Development Corporation, or NSDC, and the National Center for Financial Education, NCFE.
It's a huge table.
Why did the banking regulator feel the need to invite insurance, pension, and skill development executives to the table?
Because poverty is multifaceted, so the solution must be multi-agency. Think of the NSFI like a massive disaster relief operation, but repurposed for long-term economic empowerment.
That's a great way to look at it.
The RBI simply cannot achieve true financial inclusion alone. If the RBI ensures a person gets a business loan, but that person lacks the vocational skills to actually run a business, the inclusion fails. That is why the NSDC, the Skill Development Corporation, is at the table.
Exactly. Or let's say the person uses the loan, starts a successful business, but then a medical emergency hits their family. If they lack health insurance, their business capital is wiped out overnight to pay hospital bills. They fall right back into poverty.
Right.
That is why IRDAI, the insurance regulator, is at the table. If they don't know how to save for old age, you need PFRDA.
The output of this massive multi-agency collaboration was approved by the FSDC, the Financial Stability and Development Council Subcommittee, and it was officially launched on December 1st, 2025 by Governor Sanjay Malhotra.
And the entire strategy is built on 5 core pillars, which the RBI refers to as the Panch Jodi.
Panch Jodi. If you have a subjective essay question on the future trajectory of India's financial ecosystem, structuring your answer around the Panch Jodi will score you massive points.
Definitely. But we aren't just going to read you a list. We need to explore the real-world friction behind these pillars. Pillar 1 focuses on improving the availability of an equitable, responsible, and affordable bouquet of financial services for households and microenterprises.
Right. It's about ensuring the products actually fit the consumer rather than forcing corporate banking products onto rural farmers.
Exactly. And Pillar 2 is deeply important. It mandates a gender-sensitive approach for women-led financial inclusion and differentiated strategies for vulnerable segments.
Let me push back on this a bit.
Sure.
Why does gender need its own specific standalone pillar in a macroeconomic strategy? Doesn't a bank account work exactly the same way for a man or a woman?
Well, the technology works the same, obviously, but the socioeconomic friction is vastly different. In rural India, land titles and property deeds are overwhelmingly held in the names of male heads of households.
Ah, I see.
So if a woman wants to start an enterprise and goes to a bank, she structurally lacks the collateral that a man might have access to. Furthermore, digital literacy rates and access to personal smartphones are historically lower for rural women.
That makes a lot of sense.
Yeah, Pillar 2 exists because if you apply a blanket gender-neutral policy, you inadvertently exclude millions of women due to these entrenched structural barriers. You need differentiated, highly specific strategies to bypass that friction.
Got it. Okay, moving on to Pillar 3, which focuses on synergizing livelihood, skill development, and the support ecosystem, linking them directly with financial inclusion. This goes back to our point about the NSDC. Capital without confidence is just debt. You have to skill the borrower.
Absolutely. Then Pillar 4 leverages financial education as a primary tool for promoting financial discipline. It isn't just about teaching them how to, download and use an app. It's about teaching them a discipline of compounding interest, the dangers of over-leveraging, and how to manage daily cash flow.
And finally, Pillar 5 is about strengthening the quality and reliability of customer protection and grievance redressal measures.
This is so critical.
It really is.
Yeah.
If a digital transaction fails and a daily wage earner loses a week's pay in the digital ether and they can't get it back quickly because the grievance system is broken, they will abandon the digital ecosystem forever and just go back to cash.
Trust is the most fragile currency in this entire system.
Exactly. And to execute these 5 pillars of the Panchayoti, the NSFI features a highly specific menu of 47 action points distributed across the various financial sector regulators. They all have their marching orders.
And they are operating on a very strict timeline. When we look at the agenda for 2026-27, we have to highlight the Utkarsh 2029 goals. Under Utkarsh 2029, the RBI has established a hard deadline.
Achieving 100% EDDPE coverage in all identified districts across the country by March 2027.
Not 80% of districts like they achieved this year, but 100% everywhere. Absolute digital saturation. Additionally, they're slated to comprehensively review the framework for the revival and rehabilitation of MSMEs, focusing on faster resolution of financial stress.
We have covered a massive amount of ground today.
We really have. From the nuanced mechanics of the 20 lakh MSME collateral limit and MSME SAMVAD to the profitability shift that drove the 45% PSL achievement.
We clarified the KCC data anomaly. Don't fall for that trap on the exam. We mapped the shift from the FIP to the MPFI return and explored the fixed point BC infrastructure.
We broke down the FI index improving to 67.0, relying heavily on our gym analogy to explain why usage and quality are finally driving the score up. And we unpacked the multi-agency Panchayoti framework of the NSFI 2025-30.
The key to mastering this material for your exam is not just regurgitating isolated numbers. You must demonstrate to the examiner that you comprehend the macro transition.
Right.
India is moving rapidly away from the era of merely opening bank accounts, the access phase, and is now tackling the infinitely more complex challenge of ensuring those accounts are used safely to build sustainable livelihoods. If you can articulate the shift from access to usage and quality, you will fundamentally master the subjective portions of your test.
And to leave you with one final provocative thought to mull over something that builds on everything we've discussed today.
Let's hear it.
We have seen the RBI push aggressively for digital inclusion, celebrating 100% EDDPE coverage in 710 districts. But as we move toward total digital saturation by 2027 under Utkarsh 2029, ask yourselves this. When every single citizen, down to the most remote village, is a digital node in the financial system, does the concept of financial inclusion morph entirely into a cybersecurity challenge?
Oh, wow. That's a great point.
Right. Is the next iteration of the FI index going to be less about access because everyone is already connected and almost entirely about digital resilience? Think about how the regulator's job completely flips upside down when the initial mission of inclusion is finally marked accomplished.
If the financial system is no longer a localized cash-based landscape, but a fully connected national digital grid, protecting that grid from systemic shocks and cyber vulnerabilities basically becomes the paramount directive.
Suddenly, you aren't just trying to pump blood to the extremities, you are trying to protect the entire nervous system from a virus.
That's a powerful way to look at the future of this space.
We want to warmly wish you the absolute best of luck on your exam. You now have the insights, the underlying logic, and the frameworks of senior analysts. You are more than ready for this. Thank you for joining us on this deep dive into the source material.